A very warm welcome to you. This is Business Morning. Thank you for joining us. I'm Chimeze Obi Iwago. Well, the International Monetary Fund says Nigeria would need additional spending of 18 percentage points of its gross domestic product by 2030 to achieve sustainable development goals. In its report titled Technical Assistance, Additional Spending Towards Sustainable Development Goals for May 2020 released yesterday, the report says making progress in the Sustainable Development Goals requires substantial additional resources. The IMF noted that Nigeria faces serious development gaps. According to the report, half of the student-age population is enrolled in schools. Healthy life expectancy is 49 years, placing Nigeria among the bottom 6 countries in the world. Some 54% of the population is connected to an electricity grid that collapses about once a month. Roads are in precarious condition. Less than 4% of the population have access to safely managed water. Overall, Nigeria's indicators of human and physical capital are worse than countries with lower GDP per capita. The IMF stated that unlocking the potential of a rapidly growing population requires substantial improvements in human and physical capital. It states that Nigeria is Africa's most populous country and its largest economy, adding that its population was projected to grow by 30%, about 60 million people between now and 2030. And so the fund is advising that to raise living standards, reduce poverty, and provide better opportunities for the growing youth, Nigeria needs to invest more on its people, and that's talking about education and health, and of course its infrastructure, talking about roads, electricity, and water and sanitation. In the meantime, Nigeria has just marked its 21 years of democracy, and a lot of people have continued to question how much of dividend of democracy have been reaped. The Lagos Chamber of Commerce and Industry is the latest to comment on Nigeria's economy in 21 years of democratic dispensation. The LCCI reviewed the country's economic performance in 2015 against 2019 for a fair assessment and comparative analysis. Joining me now to look at some of the findings is the Director General of the Lagos Chamber of Commerce and Industry, Mr. Muda Yusuf. Thank you very much, Mr. Yusuf.
Thank you very much. Thank you. It's a pleasure to be here.
Now, how well is the democracy in its current form working for the private sector?
Well, first, from the point of view of the perception of the country, a 21 years uninterrupted democracy, at least projects the country as one of the most stable democracies. And for investors generally, the investors are more at ease with democratic environment. So that is one positive. The second is that the democratic structure, to a large extent, is inclusive. It is participatory. So when we have issues around the business environment, issues of policy and all of that, there is a broader room for engagement. You can't engage at the level of executive, you can engage at the level of the legislature, be it at the federal or state level. So that participatory attribute, I think, is something that is also good. Then the fact that we are also involved also in the election, there's also the value of representation. All these things may not be perfect as it is, but I think there are still positives that we can point out.
Now, in your assessment of the economy, you talked about 2015, you looked at 2015 and 2019, and we know that the present democratic dispensation started in 1999. Why the choice of this?
Well, the choice is first is to be able to compare the full data of each of those years. You know, in 2020, we don't have the full data yet. But for 2019, we have the full data. For 2015, we have the full data. And the administration came on board in 2015.
Like
that's looking at the present administration. So that was the basis, so that you can have a fair basis of assessment. Secondly, in 2020, we had this big shock of COVID-19, which is a major exogenous factor, which you may not be able to attribute, the consequences you may not be able to attribute to the present administration.
Okay, now your assessment focused on different areas. But let's look at the macroeconomic performance. Your findings show that the country's macroeconomic fundamentals are largely weak, and the situation remains the same, till date. And I'm sure you listened to the president give a kind of a scorecard of his administration, and he says, we have witnessed 11 quarters of consecutive GDP growth since exiting recession. For him, in spite of the COVID-19 crisis, Nigeria's growth trajectory has really been one of impressive.
Well, I listened to I read the speech of the president. It's very broad, very inclusive. He covered practically all grounds, and practically in all areas of the economy or of our life. I mean, something has been done, so we must acknowledge that. But when we look at the macroeconomic fundamentals, part of the reasons we have the challenge we have now is because the macroeconomic fundamentals are weak. We have still not built the economy to a point where we can withstand any serious shock. I mean, look at our excess crude account, for instance. It has practically dried up. As we speak now, we don't have any tangible buffers. The exchange rates, you can see what is happening to the exchange rate now. So generally when we look at the macroeconomic fundamental, it's still very weak. And it's weak also because we are still heavily dependent on oil, in spite of all the efforts at economic diversification, even since 1999 up to date. If you look at the structure of revenue, the structure of our foreign exchange earnings is still heavily dependent on oil. So all this point to the fact that the economic fundamentals are still weak. Because for you to have very solid fundamentals, you should have a much more diversified economy. Not necessarily in the sense of the distribution of the GDP numbers, but also the capacity of each of those sectors to generate revenue, to generate foreign exchange, and in a very sustainable way. So these are the more concrete ways to measure how strong the fundamentals of an economy is.
Okay, you also looked at the present administration's performance from a socioeconomic and, of course, a welfare perspective, and you said it's not up to scratch.
Yeah.
You alluded to the risk posed by poverty to democracy and security. Now, when the president spoke, he said, I have to quote him now, our social investment program has continued to be a model to other nations and has engaged 549,500 NPAR beneficiaries, 408,682 beneficiaries of the conditional cash transfer program, and of course 2,238,334 beneficiaries of the growth enhancement and empowerment program. How about this? Now, you saw the report I read earlier before the show coming from the IMF talking about the need to invest on human capital development. And for them, Nigeria has not got it right there.
Well, your report says it all. We must acknowledge that government has done some things in the area of social investment and all of that. But in terms of the materiality of what has been done, vis-a-vis the magnitude of the problem, it's still a far cry. The latest report of the Nigerian Bureau of Statistics put the poverty rate, the poverty rate as 40%. That is huge. We're talking about 80 million people, in extreme poverty. And there is this report by the World Poverty Clock or something that says that Nigeria has overtaken
so all
India.
of these social investment program, in other words, how much impact have they even made?
Significant. That is why the numbers are still showing what they are showing. Because the problems are huge as far as the social problems are concerned, particularly in the area of poverty, in the area of access to health, in the area of access to education. Those things are still in a very, very bad shape. And some of the reasons is that we have not also structured our spending in a way to be able to support all these socio-economic pillars, because these are the pillars that can, transform the social environment of the country. So we need to look at the way we spend. We need to look at the structure of our spending. We need to look at the structure of our budget. I mean, look at over the years, look at the structure of budgeting, the current to capital, And even within the space of capital expenditure, what percentage of capital are you putting in infrastructure? What percentage are we putting in health, in education? And this is not just a federal issue, I must say. It's an issue that has to do with all the levels of government, whether local, states, and federal. So we have to take all these things together, and we should continue to engage and prevail on the government to ensure that we have a better structure of spending, we reduce the cost of governance so that we can have more resources available to develop some of these very critical infrastructures.
All right, now let's look at the global ranking. It's also part of what you looked at, and of course, the president, yes, talked about that, and he was quite impressed and says that Nigeria has risen by 25 places on the World Bank's Ease of Doing Business ranking, about 146 to 131, and is now rated as one of the 10 top performing countries. Are you impressed too?
Well, I will say yes to some extent. I say yes because it's an indication that we have done some things right. At least for that ranking to move by almost 25 or 26 steps, it's an indication. But whether the improvement has been impactful enough is a different matter. Because some of the reasons we will have very serious challenges with productivity in the economy today, challenges with competitiveness, has to do with the quality of the investment climate. And again, some of these reports, the parameters on which they are based are not also country-specific in terms of the strength of those parameters on the business environment. For instance, things like security doesn't feature as part of those parameters. The challenges we face, severe challenges we face with power, not just connecting electricity, but sustaining the quality of delivery of power. It doesn't feature as a major parameter in this. The challenges we face in the ports and all of that, logistics, these are very critical factors that impact on the business environment. These things don't feature in the parameters used by the World Bank. And I've engaged the World Bank on this, that this kind of report or assessment should be country-specific. It should take into account the peculiarities of each country and the weight of each parameters on the business environment. That's where we have a clearer picture. And that will also assist the government in focusing its priorities when it comes to intervention to improve the business environment.
All right, just a quick one before I let you go. Your role is majorly advocacy. Now, what is the most worrying situation in Nigeria, this 21 years of democracy, and what are the major reforms you would love to see?
Well, the most disturbing, of course, is the investment in infrastructure. Whether we are talking of economic infrastructure or we are talking about social infrastructure. We need to come up with models that work for us to mobilize capital, public sector capital, private sector capital, to support the development of social and economic infrastructures. Because the progress we make as an economy, either economically or socially, depends on how much progress we make in investing in these key infrastructures. So we need to have reforms around funds mobilization. We need to look at our regulatory environment and see what areas we can reform to ensure that we attract a lot more capital into this economy.
All right. Thank you very much for your time, Mr. Muda Yusuf.
Thank you very much. It's my pleasure.
Muda Yusuf is the Director General of the Lagos Chamber of Commerce and Industry. Okay, let's turn to the world of commodities. All right, let's look at the global oil market as prices slid this morning on lingering concerns over the threat to fuel demand from the resurgence of new coronavirus infections around the world, though hopes for further cuts in crude supplies stemmed losses. We had Brent crude falling 20 cents at $39.52 a barrel, having gained 2.6% on Monday. U.S. oil dropped 21 cents to $36.91 a barrel after closing 2.4% higher in the previous session. Okay, let's bring in Desola Sumoni, one of the research analysts with Financial Derivatives Company, to look at some of the development there on the global commodities market. Hello, Desola. Good morning. Thank you for joining us.
Hi, Chimeze. Good morning. Thank you for having me on the show.
Right. So how worried are you over the volatility in the oil market currently? There are jitters that a rise in coronavirus infections around the world could hurt fuel demand, but hopes that production cuts could be extended seem to keep price declines in check.
Thank you for that question, Chimeze. Like you rightly said, over the weekend in the United States, we saw 25,000 new cases, new coronavirus cases, with sharp increases coming from Texas, Arizona, and Florida. Similarly, in China, after about 2 months of no new cases, we saw last week about 80 new cases in Beijing, and this, has raised concerns about a second wave, what some analysts are calling a second wave of infections, which has also raised worries about a second lockdown. Now, this is particularly worrying because some analysts have forecasted that a second lockdown would be would have a worse impact on economic activities than the first lockdown for a number of reasons. One is because of quarantine fatigue. People are sick and tired of staying at home. I am sick and tired of staying at home. Also, there are issues about solvency of businesses. There are many businesses already are insolvent, and many other businesses, if they go if there's another lockdown, cannot survive another lockdown. Now, second lockdown is not far-fetched. I mean, we've already seen it happen in some economies. I've seen it happen in Hong Kong. I've seen it happen in Singapore. I've seen it happen in Japan. Now, on the effect of OPEC, we are seeing that this a second wave of cases, a second wave of cases is going to drag economic activity, go to dent global oil demand, and the OPEC-led production cuts is not sufficient, is not deep enough to offset the markets, and that's why we are seeing this volatility. Yeah.
Okay, now with this volatility in the global oil market space, is it not time for Nigeria to do away with oil money, perhaps?
We've had this conversation before, Chimeze. Whenever there's a global oil price shock, we have this conversation about diversifying away from oil. Sometimes the government pays lip service to it. Oh, we're going to diversify, but we don't really see any changes. I mean, in terms of economic activity, Nigeria GDP is well diversified in terms of economic activity. The real problem is the composition of revenue, or the composition of export earnings, which still solely depends on oil. I mean, we have some revenue coming from agricultural exports, but the agricultural exports are still primary exports, and they are dwarfed by oil exports. Also, we are seeing talks about increasing tax revenue, increasing the tax nets, increasing collection, and things like that. While that is positive, that is good, still, as it stands, all these other sources of revenue are still dwarfed by oil revenue. So I think what we need to do is we need a strong political will from the government. We need more than lip service, because we've been here before. So we need a strong political will by the government, so that we can grow our internet generated revenue, we can grow tax revenue, we can grow revenue from agriculture, from construction, from other sectors of the economy, to be as big as, and potentially bigger than, oil revenue, so that we are not always exposed or vulnerable to exogenous oil price shocks.
All right, Desola, just hold your thoughts there. There are quite a number of burning economic issues there. We would want to understand how those would affect Nigeria, and particularly on the domestic commodities front. Just hold your thoughts there. We'll take a quick break and we'll be back in a moment. Thank you for staying tuned, and we're still talking about the commodities market, and Desola Sumoni is still there with us. Yes, Desola, we have quite a number of burning economic issues there. We have, of course, the UK economy declining by 20.4%, developing countries going on a borrowing spree. We have a recent bankers committee meeting advising banks to raise new letters of credit. How would you relate all of these to the domestic commodities market? What are the implications?
These are many issues to unpack, Chimeze. Let's start with the UK economy. So, like you said, the UK GDP declined by 20% in April. I think it's important to note that the UK is one of the few economies globally that records monthly GDP. Can compare that to GDP for March, we declined by about 5.8%, or February, we declined by a negative 0.2%. How does this affect us as Nigerians? First of all, I think one of the transmission mechanisms is through remittances, and it's important to note that Nigeria is the largest recipient of remittances in Africa and sixth largest in the world. As of 2019, the World Bank estimates that Nigeria received about 25 billion US dollars in inward remittances. Now, it's also important to note that the UK is the second largest sender of remittances to Nigeria, with about 190,000 Nigerian migrants living in the UK, of which I am one of them. And the US also is the US is the largest sender of remittances. So the decline in GDP in the UK plus what is going on in the US as a result of coronavirus pandemic is projected to impact remittances significantly. As a matter of fact, the World Bank estimates that inward remittances to developing countries would decline by 20% in the year 2020. So the effect will be most visibly seen in terms of lower foreign exchange inflow of foreign exchange from remittances. But I think the stronger effect will be at the micro level, in terms of the households that actually receive these remittances, because they receive these remittances and they use it to smoothen consumption, to mitigate against income shocks, and most times to pay for school fees for their children. So it's going to affect this human capital development that we're talking about. So I think that's the impact of that on Nigeria. In terms of the domestic commodities market, I think the clearest impact, or the most direct impact on the domestic commodities market, would be in terms of the exchange rate pass-through effect. The exchange rate pass-through effect. We're already seeing domestic commodities prices increase, and although I think domestic commodity prices increase, and one of the this also coincides with the planting season. For instance, I've seen inelastic commodities like tomatoes, pepper, onions increase by as much as 50% month on month. Okay, so the next issue we want to talk about is the bankers committee recommendation that okay, go on, go ahead, go on.
Well, Desola, we really do not have much time there. Yes, you have just reeled out the commodities prices movement, which of course is on the rise. And then we see that Forex rationing is taking a toll on commodities prices. And of course, reduction in petrol price has no impact on transport fares and logistics costs. Could this be the reason FDC is forecasting a further increase in headline inflation to 12.50% in May from 12.34% in April?
Taking the words right out of my mouth. Yes, that is exactly the reason why we are forecasting that. Although we expected that, like you said, we expected that the reduction in price of PMS would increase aggregate demand, but unfortunately, we are not seeing that. Increase in aggregate demand. Rather, we are seeing the exchange rate pass-through effect. We are seeing disruptions in logistics, in the supply chain. We're also seeing logistic costs push domestic commodities prices higher, and that is why we are forecasting that inflation will increase to 12.5% in May from 12.34% in April.
All right, thank you very much for your time, Desola Sumoni.
Thank you for having me.
Thank you for staying tuned, and still looking at the developments in the global oil markets. The prices slid this morning on lingering concerns over the threat to full demand from the resurgence of new coronavirus infections around the world. Though hopes for further cuts in crude supply stemmed losses, Brent crude fell 20 cents at $39.52 a barrel, having gained 2.6% on Monday. U.S. oil dropped 21 cents to $36.91 a barrel after closing 2.4% higher in the previous session. Coronavirus cases rose to more than 8 million worldwide by Monday, with infections surging in Latin America, while the United States and China are dealing with fresh outbreaks. But some observers said they didn't expect to see any return to the stringent lockdowns seen at the start of the year. Analysts say hopes of more cuts in oil supplies by major producers also helped prevent steeper price drops. Prices rose on Monday after the United Arab Emirates energy minister expressed confidence that OPEC Plus producers, members of the Organization of the Petroleum Exporting Countries and allies, including Russia, that have not been in full compliance with previously agreed cuts, would up their gains. And production from 7 major U.S. shale formations is likely to drop to close to a 2-year low of 7.63 million barrels per day by July. The U.S. Energy Information Administration, of course, said this on Monday. U.S. drillers have slashed production and the number of oil rigs fell below 200 last week, the lowest since June 2009. And the International Monetary Fund says Nigeria would need additional spending of 18 percentage points of its gross domestic products by 2030 to achieve sustainable goals. In its reports titled Technical Assistance, Additional Spending Towards Sustainable Development Goals for May 2020 released yesterday, the fund says making progress in the Sustainable Development Goals requires substantial additional resources. The IMF noted that Nigeria faces serious development gaps. According to the report, half of the student-age population is enrolled in schools. Healthy life expectancy is 49 years, placing Nigeria among the bottom 6 countries in the world. Some 54% of the population is connected to an electricity grid that collapses about once a month. All right, the coronavirus pandemic has not only affected governments, communities, and families, but has impacted global economies, bringing about unprecedented market uncertainties and fluctuations, and making the management of as well as changes in the markets become increasingly imperative to the operational efficiency for businesses and individuals. And so the FMQ Securities Exchange Limited is set to host stakeholders discussions on this for better understanding of how to manage the risks. So to tell us more about this is the Managing Director, FMQ Securities, Tumi Shekoni. Thank you very much, Tuni, for joining us on the show.
Thank you for having me. Good morning.
All right, combating currency exchange volatility through risk management tools, that's the theme of your discussion. So tell me why this has become imperative at this time.
Well, as we all know, the entire world pretty much has been shaken, if you will, by the COVID pandemic. And what is apparent in this pandemic is that there's a lot of uncertainty. Now, with uncertainty in the markets, you require tools to sort of help you manage, the risk that you're going to face, at least to some extent. So what FMDQ has done and what we've tried to do is to see how we can educate the market, educate stakeholders on some of these tools that they can use to help manage the risks that they're being faced with at this time. So the theme for the... Okay, sorry.
Go ahead, go ahead. Go ahead, Tudi.
Okay, so the theme for the... Okay, yes, I can hear you. But so the theme for the FX derivatives webinar that's coming up tomorrow, Wednesday, 17th at 12 noon, is to basically educate the markets, let them know about different risk management tools available, and particularly the OTC FX futures tool that is product that's available, especially in this time where, as you can all see, as we can all see in the Nigerian market, the FX market is obviously facing some challenges, again, like maybe different sectors, again, in the economy.
Yeah, the Naira futures has been hovering around 550 Naira per dollar for some time now. Give us your regulatory perspective of this development.
So with respect to the Naira futures, FMDQ Exchange is the market organizer, is the sort of administrator, a regulator. We do have standards that the markets would have to abide by in terms of participation in that product. So what we do is pretty much ensure that there's transparency in the market, ensure there's some sort of governance in that market so that the product is traded appropriately. Now, what happens with respect to the rates is what happens is the market sort of participants, coming together to trade in that product. So from a regulatory perspective, as you see, we do not necessarily have regulators of that product. There wouldn't really be anything that would say but to provide that market transparency so everyone can actually see what is going on in the market.
So talk to us about the parties involved in most of these contracts. Are they foreign portfolio investors or institutional domestic players?
So with respect to the transaction parties, you would have the seller and the buyer. And in this situation, the seller, the sole seller of the product of the futures contracts is the Central Bank of Nigeria. And its counterparties would be the deposit money banks, who are actually futures banks. Now, what you would find is the futures banks do purchase these contracts for onward selling, if you will, to their clients, which would be the foreign portfolio investors, even local importers, different stakeholders, essentially anyone who has an FX exposure that they would want to hedge with the.
Hello, Tuni.
Yes, I can hear you. Did you get the last thing I said?
Okay, yeah, all right. The exchange has seen the development of the green bond issuance rules by the Securities and Exchange Commission. It will, however, appear that there are more laws and rules that the market is in application or anticipation of, such as the laws for repos. What are the preparatory ground towards realizing these goals?
So the goals with respect to the green bond market, essentially what we're trying to do is to develop the non-sovereign green bond market. And apart from developing the non-sovereign green bond market, is to let the market stakeholders sort of understand the benefits of green will. And again, with this coronavirus pandemic, the importance of sustainability cannot be overemphasized. So what FMDQ is trying to do with its partners, FSD Africa, as well as CBI, Climate Bonds Initiative, is to come up with a program to help develop the Nigerian non-sovereign green bond market. With respect to repos.
Go ahead.
Okay, yeah. So with respect to repos, FMDQ is launching a repo with collateral management products, again, to bring in new sort of products in the market that can be traded, that are actually needed and useful in the market. So FMDQ is working with the market participants, most especially the banks, in spirit, working towards launching the repo with collateral management product.
All right, thank you very much for your time. Tumi Sekoni, the Managing Director, FMQ Securities.
Thank you very much.
Okay, we move over now to the markets for Monday's trading activities at the equities market, and here is Temple. Well, Temple, it wasn't a good start for the equities market
Not
yesterday.
at all, not at all. It was not a good start, and that's something that is really surprising. But at the same time, in some quarters of the market, it's not so surprising because we all know what the potential decline in crude oil is likely to cost to the market, and that's something that is already playing out at this point. Of course, we also have been hearing about the second phase of the coronavirus, which is something that investors, especially the offshore holders in the market, have been reacting to that. So but basically, we're down yesterday some 0.91%, and of course, that reduced the equity capitalization from 13.17 trillion naira to this position that you can see right here. Look at the volume of transactions. We're down by some 30% in terms of volume, in spite of the fact that we got some addition from FBN Holdings, where we also saw some level of profits taken yesterday. Now look at the value of transactions. That was also down by some 53% in all. The deals was down to 4,808. This figure here shows some level of sell-off, at the same time profits taken, because if you look at the market breadth for yesterday, was very, very bearish. We saw some 25 losers in the market as opposed to just a few gainers in the system. The banking stocks yesterday saw a lot of decline. Sterling Bank, EcoBank, Transnational Incorporated, a lot of the key banks that you have in this space were also down yesterday, impacting the performance. The points we have was 193 basis points. Look at the consumer goods segment of the market. It wasn't too good as well yesterday. Nigerian breweries was down. Key companies that you have in this space were also down. Industrial goods side of the market by 2%. WAPCO, that's Lafarge, was down, and we saw some more than 1% profit taking on Bois Cement. Insurance space saw a little bit of uptick thanks to the recapitalization that has actually been panning out in that space as well, even though we know that some of the key companies were down by about 9 to 10% yesterday. Oil and gas, though impacted this segment very, very negatively. Most of the other companies that you have available in this space, not so much of movement yesterday. And if you look at the NASD OTC, which is an area where a lot of the stockbrokers of the Nigerian Stock Exchange also trade, there we saw a little bit of traction, up some 1.92%. We saw investors betting on WAMCO, which even made some gains yesterday. CSCS also contributed to what we have here, VFD Group, and in fact, Food Concept, which made a comeback on this side of the market. We have Mr. David Adonri, who is a stockbroker with FMQ Securities, joining us this morning. Mr. Adonri, thank you for joining us on the program. But can you tell us if we are now back in a bear's market at the equity side of things?
Yeah, thank you very much, Tempo. You are actually very correct. We are seeing a market that is a little bearish due to the impact of the economic gloomy situations both locally and globally. We have seen that COVID has actually resurfaced much stronger in the U.S., and the U.S. capital markets have reacted to it, and that is also panning out in the local capital market that is also taking a cue. Additionally, the economic indicators in the third quarter were not very, very encouraging, and the forecast is that the situation will even deteriorate further in the second quarter. So there are enough reasons for the market to be a little bit bearish as a result of these economic events.
I know we don't know how long that is going to last, but we'll just continue to watch. But Mr. David, Mr. Adonri, rather, I should quickly ask, the pharmaceutical sector seems to be gaining some traction lately. FitSyn's been up by more than 40% lately. Namet PLC has also been up by more than 200% until yesterday when we saw a bit of profit taking on the counter. Can this really hold sway for the market?
Yes, although that sector is not very, very significant as to affecting the direction of the market. But attention globally and locally are now being focused more on the pharmaceutical industry because of the state of the global health situation. And so we also know that the Central Bank of Nigeria is supporting the pharmaceutical sector very, very massively. So these will eventually impact on the returns on investment in that sector.
Right. All right. Thank you so much. FMQ Securities Limited, a member of the Nigerian Stock Exchange. We appreciate your insights. It's back to you now, Chimeze.
Thank you, Tempo. Well, hang in there. We'll do an opening call to London as soon as we get back from the break. All right, let's move to the streets of London. And here's Juliana Olanka. Hello, Juliana. Good morning. Well, long queues of shoppers were seen outside stores in England on Monday as coronavirus restrictions on non-essential retailers were lifted. But figures showed the number of visitors to high streets and retail parks was a third lower than this time last year. Tell me, what was it like yesterday on the high streets?
Good morning, Chimeze. Well, it was busy. I think those figures, of course, are relative because this time last year there wasn't a pandemic creeping across the world, particularly in Britain, and it was very busy yesterday. Britain is seen or is known as being one of the most coronaphobia nations on earth. Many Brits are scared to come out of their houses. So the fact that people were queuing for hours upon end in some places, outside some stores in Oxford Street, just where we were, there were queues that were going around the block, particularly for Selfridges, Primark. Primark fever is certainly back all across the country. People were queuing to get their hands on those items, particularly as Primark don't have an online presence. So if you wanted to grab a bargain yesterday, that appeared to be the place. But in all seriousness, you know, the British High Street definitely needs this kick. It's hoping that yesterday won't be a flash in the pan, that perhaps this will see a resurgence in people returning to the High Street. You know, the fact that they've been browsing online or buying online for the past 3 months, that may have kicked in an instinct for people to want to get out and spend some money. According to the British Retail Consortium, £1.8 billion a week is what was lost during this almost 3 months of a lockdown. And Chancellor Rishi Sunak is considering whether or not he will cut VAT in this country. And if he does that, that could send more people out to go and spend their money. But it certainly was busy. They definitely felt like people were out and about and ready to spend their money again. And the hopes are is that this can continue over the next couple of months.
And in another development, some influential group of MPs are calling for a total ban on gambling advertising and calls for the biggest shake-up of Britain's gambling laws in more than a decade. What is the reason behind this?
Well, the reason is, Chimezie, is that Britain have a problem with gambling. There are an estimated 4 million people addicted to gambling, and it's $1 billion business, £1 billion business, shall I say. And the problem that a lot of cross-party MPs are saying is that this is affecting people's mental health, and it shouldn't be that they're making so much money and it's affecting people in such a drastic way. And this cross-party group have been successful before. They lobbied to get credit cards banned on using online slots. And now what they're asking for is that online advertising should be banned, not just on TV, but online. There are several other things that they're asking for as well. They want a £2 stake limit on slot machines and an end to VIP schemes. Now, the VIP schemes are very controversial because basically the gambling companies reward people for losing lots of money. So they're really concerned, and they are going to be putting a report to the government today in hopes that there will be some stronger legislation, particularly for the advertising, which is what's really going to rub the noses in the wrong way for commercial broadcasters and the gambling companies, because since these MPs have been fighting back against gambling companies, millions of pounds have been wiped off their share value, but they're doing it for the greater good, and they want the government to take more responsibility. We do have a gambling commission in this country, which is the industry regulator, but the MPs are saying it's not fit for purpose. They're not interested in helping the everyday individual. So that report will be released to the government later today, and it'll be interesting to see what their response will be.
We'll look out for that. And in corporate news, Jaguar Land Rover, UK's largest automotive company, is to cut more than 1,000 UK agency staff after losing about £500 million in 3 months due to the coronavirus pandemic. Now, this will certainly add to economic pressure, but aside from coronavirus, what is Jaguar's profitability like?
Well, you said the numbers there. They lost £500 million in their final quarter. And they also said they had a 31% drop in sales. Again, this is something that we're seeing everywhere, not just in Jaguar Land Rover. I believe that Bentley and Aston Martin have also released similar figures. And they have also, over the past couple of weeks, dropped some of their staff. And redundancies is something that we're expecting to see more and more of in this country. I think Jaguar Land Rover have about 31,000 in total staff working in the UK. Just late last year, they already dropped another 5,000. So it's a worrying issue. But I've got to talk about the biggest issue of the day, which is a wider story, and that's about the UK labour data, which came in this morning from the Office of National Statistics, showing that there are 3.9 million unemployed, really pretty much the same figure that they reported last month. But what the focus appears to be on in this country is the 600,000 people that have been removed from the payroll. This information goes straight from employers to HMRC, and there's a major focus on that. There seems to be a forensic look at just why so many people are dropping off the payroll, particularly as the furlough scheme is just going on. So the furlough scheme seems to be working at the moment, but when that comes to an end in October, we are expecting to see mass unemployment everywhere.
Well, I'm sure the markets will be chewing that data now, and so we'll be ready to get more update on that from you later in the day, Juliana.
Thank you.
And back here on the debt and currency market, back to you again, Temple.
Sure, thank you, Chimeze. We got some buy sentiments, but with a mix of sell sentiments at the bond side of the market yesterday. If you look at the 2036 paper, it was mixed. We saw some buyers, we saw some bargain hunting on this side of the market, but there was more of bargain hunting on the 2034 paper, and of course the 2049 security on this side of the curve, albeit some 2 billion naira exchange for this particular paper, and some 1 billion naira exchanged against the 2034 paper. These were the two key areas where we saw some key interest. But if you look at the 2035 and 2025 and 2036 securities, here we saw some sell down, and we saw a little bit of buying that informed these numbers that we have here. Look at the NCB side of things. Not so much of activity except on the 13th of May 2021 paper, which is the newly issued one-year program from the last auction by the DMO and the CBN. Here we saw some 23 million naira as opposed to some selling that we saw across the 2021 paper, which is at the longer end of the curve. In terms of the open market operations maturities, right here, a bit of interest around the longer end of the curve, the 1st of December the 1st of December 2020, which is at the shorter end or mid end of the curve, and 29th of December 2020, were some of the key papers where we saw a bit of demand. If you add this to what we have as well, some 3 billion naira positioned against this particular security also helped the markets yesterday. But basically, we've got the federal government settling today the 162 billion naira worth of sukuk transaction that was carried out a few weeks ago. That settlement holds today, and that's something that we'll be expecting Ramas Baba, who is the chief dealer with FBN Quest Merchant Bank, talking to us about this morning. Ramas, thank you for joining us on the program. So how much of resizing or rebalancing will these 162 billion naira debits be bringing to system liquidity today?
Hi, good morning. So the much awaited sukuk finally settles today. Yes, the 162 billion will be going out of the system. The system is pretty much liquid, about 225 billion up opening today. So we just expect that to take to bring system to probably about 60 billion or thereabout up. So yes, yesterday we saw market trading at about 5 to 8%. Following the debit of the sukuk today, we actually expect market to trade as a money market to trade between 12 to 15%, depending on what side you really are.
So that is basically going to help push up liquidity, as you've explained. But how will that also shape the secondary markets today?
Sorry, just a correction. That's not going to push up liquidity. Rather, it's going to cause a drop in liquidity because it's a debit to system liquidity. Now, moving on to the secondary market, how is it going to shape the market? In the bonds market, we've seen more of sellers in the market as I think people were trying to sell up to create a bit of liquidity to settle today's auction. I'm not forgetting that there's a bond auction tomorrow, which settles on Friday. It's 150 billion on offer at tomorrow's auction, but definitely we do not know how much the DMO will be taken out tomorrow. Also, there's a T-bills auction tomorrow, though not much. It's pretty much a rollover, about 30 billion on offer and all. So how do we think that's going to shape market? Really, I think the market is just going to be business as usual, kind of, and a bit slow today because whatever funding you need for today's settlement should have been provided for yesterday.
Ramas Baba, chief dealer, fixed income with FBN Quest Merchant Bank. Thank you for those wonderful insights. We appreciate them. And that's it, Chimeze, from the debt and currency side of our market.
We'll see how things play out today. And that's a wrap on the program. Thank you for watching. I'm Chimeze Obi. You're welcome.